Welcome back to another episode. If you are new here, on this channel I am documenting my Wealthsimple trade portfolio. I use a dividend growth strategy and currently have about $480 in this account. The markets have been extremely volatile the last week or so, and it shows in the returns. When we look at other intervals, we see the portfolio is not really doing that bad. Today, I want to share what I believe the investor mindset is and show how the market pullback shouldn't scare investors as much as they typically do. My strategy focuses on dividends. I want to buy companies that pay growing dividends and use these dividends to buy other profitable companies, creating a powerful compounding effect. In this portfolio, I'm currently focused on growing a few key holdings that will drive this compounding effect. The first being Vanguard's High Dividend Yield Index ETF, VDY. Every week I deposit more money and only buy this ETF. If you want to see more about this ETF, see my VDY review. During the dip in the last week, I bought more shares. We can see how VDY dipped to about $40 a share. When we see the historical trajectory of VDY, we see a decent growth of about 25% in the last year. VDY holds some of the biggest companies on the TSX, so this ETF does follow the Canadian markets fairly well. By looking at the historical returns of VDY, this recent dip should be no concern for investors and provide a chance to lower their cost basis of their holdings that they have conviction in. Currently, I hold 11 shares at a cost of $42.22 per share. Regardless of the price of VDY, I will continue to buy, increasing that compounding effect I mentioned earlier. This portfolio has a yield of 4.05%, which means I will earn $4.05 in cash for every $100 invested into VDY. My goal right now is to grow the monthly income and use the new cash to buy more shares every month. It'll be interesting to see expected dividends when VDY's position has grown and other dividend paying companies are held in this account. Right now, VDY only produces about $1 in cash every month, but this will grow considerably in future months. The power of compounding is shown when we look at a larger time scale. After 10 years without buying more shares, our annual income would grow from $15 to $35, which is over double. So think about what a longer time frame will yield. After 25 years, that $15 income will turn into $181 per year. These calculations are based on VDY's past results by using its dividend CADGAR or the compound annual growth rate. So I'm not concerned about the short-term fluctuations in the market, as I trust my positions will be profitable in the long term. To visualize this idea better, let's take a look at the dip in the TSX over the last week and see how this compares when we look at a larger scale. The TSX over the last week and month has fallen nearly 4%, but even when we look at the 6-month and year chart, we see how the TSX has provided sizable gains. An investor should be prepared to go through rough patches where the market returns are negative. We can't expect to have straight growth. The market has to digest news and policy before progressing. The negative returns this week are insignificant the further back we go. Like in Track Your Dividends, I analyzed annual income after 25 years. Let's look back a few decades and see how much the TSX has changed. If we look back between the years 1992 and 1993, we see the market traded fairly even with a little sell-off in the beginning of 1992. We have to consider these gains without dividends, as this index only considers share price. If you were an investor during this period and looking at the minute fluctuations causing you to buy, sell, and change your holdings on a regular basis, you likely missed out on gains from being consistent and confident with your holdings. As we zoom out to get a larger macro picture, we see the market gains in the coming years in 94 and 95 and in the beginning of the 2000s. When you look at the years 92 and 93, we can already see how much growth happened during this period. Even after the dot-com bubble, we see the market recover in 03 and 04 until the financial crisis in 2008, where many companies were restructured to mitigate risk. In the last decade, the market has been fairly stress-free, allowing companies to compound earnings, increasing their dividends for shareholders. Even the 2020 crash seems small when we scale back the charts like this. We can see the general outlook of the market before, during, and after economic crises, and in each case has led to the growth in the long term. From 1992 through to 2021, the market nearly 6x'd, and this is without dividends. I believe we can expect similar trends to those where the market goes through quick pullbacks followed by decent periods of growth. So when I look at my portfolio, I try to have a similar mindset and scale back the chart to see where my portfolio will be in years to come. I am not concerned with short-term fluctuations and try to stick to my strategy to provide consistent and predictable returns.